Have you seen those warnings on TV that go, "Do not try this at home"? Many times, the reason is those people are professionals and they can do whatever they are doing safely because they know what they are doing. A kid or an amateur would probably hurt themselves if they tried it. Treasury bonds are safe investments. However, if you do not know what you are doing, you can face losses. I want to guide you to know when and how to invest in treasury bills and treasury bonds. When you're done, you will be able to invest in these safe investments safely. Government bonds are an essential part of your investment portfolio, and the most crucial reason to invest in them is how they can help you manage your risk. You won't be able to achieve success as an investor if you do not know how to balance returns and risks. What do I mean? If you receive smaller returns than the amount of risk you take, or take on more risk than the returns reward you, you won't be making the best use of your savings. Losses will slowly wash away your capital. Think about it. Let's say that you own a car rental business. You rent out your cars for a month to customers. Let's add that one of your cars is worth 1 million shillings. Each month, that car depreciates by about 17,000 shillings, and you also spend about 10,000 monthly to maintain it. The least that you can ask for when renting that car out is about 27,000 shillings, and probably more because you have other business expenses. You will soon be out of business if you rent it out for less than 27,000. Investing your money and not receiving enough returns is the same thing. Investing in some government bonds helps you manage your overall risks. When you do it correctly, you can make the same returns as someone else while taking on less risk than they are. You will be like the person renting out their car at a monthly fee that covers their expenses and then some. The reason this is possible is that bonds are riskless, or rather, they have such low risks that you would practically not take any risk when investing in them. You are lending money to a government you can be sure will pay. So, what is a treasury bond? In the 1500s, people started using the word bond to refer to an instrument binding one to pay a sum to another. An instrument here implies a contract. So, you have an agreement where one person promises to pay another person specific amounts in the future. Consider it like when you take a loan and sign a document promising you will pay monthly payments to the bank. A treasury bond is a contract. Here the government creates an agreement where it promises to pay you specific amounts of money in the future. In this situation, you are the bank and the government is the borrower. A treasury bill is a type of bond. In fact, there are three terms you need to know: treasury bill, treasury note, and treasury bond. All of these are situations where you have lent money to the government on the promise that it will repay that money in the future. In the case of the treasury bill, the government promises to pay it back in 3 months, 6 months, or 1 year. For the treasury note, you will get your money back between 2 and 10 years, and anything above 10 years is called a treasury bond. Bills and bonds pay you interest in different ways. In the case of a bill, you receive interest in the form of a discount. For example, suppose the government wants to borrow 100,000 shillings from you for 6 months and promises to pay you an interest rate of 4.5% in those 6 months. In that case, you will give the government about 95,500 shillings, and in 6 months, the government will return 100,000 shillings to you. That difference, the 4,500 shillings, is the interest rate. On the other hand, treasury bonds and treasury notes pay interest every 6 months. So, if the interest rate on the bond is 12% per year, you will receive 6% after 6 months and then another 6% after 1 year. The longer the amount of time you lend out the money, the higher the interest rate you can expect. Therefore, a treasury bill will pay a lower interest rate than a treasury note, and a treasury note will pay a lower interest rate than a treasury bond. What you are looking at here is something called a yield curve. It shows how the interest rate increases as the time to maturity of the bond increases. This increase is because the longer the period you lend your money to the government, the more risk you are taking. The additional risk is small, but there is still some risk you are taking when you lend money for 10, 20, or more years. So, when do you invest in a bill, note, or bond? Before continuing, keep in mind that you will not hear people use the term treasury note often. It is not a commonly used term. Both notes and bonds are usually referred to as just bonds. Let us continue. The way to know what to invest in is first to have a goal, because if you are going nowhere, it doesn't matter if you end up in Karen or Kibera, in the Tenderloins or Beverly Hills. Therefore, when you have a goal, the timing of that goal helps you pick a suitable investment. For example, if you have a dream that you would like to achieve in 1 year, let us say that you are saving for a wedding, then you need an investment that will reach its full potential in 1 year and that has a risk profile that will allow you to have that money in 1 year. So we can conclude that treasury bills are best for short-term goals, goals you want to achieve in 3, 6, or 12 months. Treasury notes are for goals you want to accomplish in 2 to 10 years, goals such as saving for a down payment of a house. Bonds are for goals you want to achieve in about 20 years, such as retirement. While treasury bills and bonds are low risk because you can generally trust governments to pay their debts, there have been times when governments have failed or defaulted. Recently, we have had governments of Lebanon, Sri Lanka, Russia, Suriname, Zambia, and Ghana that have defaulted on their debts. A government can fail to pay its debts in two ways. First, it could fail to pay an interest payment or return the principal amount. Second, a government can fail by changing the terms of the bond. It could, for example, reduce the amount of interest or change the maturity. In both cases, you as a bond investor will be left with losses. Because of Ghana defaulting on its debts and the recent problems that the government of Kenya has had with paying bills, there has been some fear of the Kenyan government failing to honor its debts. The fear has gotten to the point where there is a video on social media where the person says that the government could go into your M-Pesa account, take your money and use it to pay its bills. While this is an exaggeration, you might also have these fears because debt default has happened in other countries. Therefore, what could you do to protect yourself? Like any other investment, you can protect yourself through diversification. Due to the high returns that bonds have offered in the past, many investors have put a lot of their money into treasury bonds. It seemed to make sense at the time. We considered bonds safe and they have been paying high returns. Why not put all your money into them? The reason you diversify is because of times like these. You need to be able to sleep without worrying about your future. Good investments can always turn sour. You can often not predict that turn, or even if you can predict it, you cannot change your portfolio without making losses. Treasury bonds have a minimum investment amount of 50,000 shillings and treasury bills have a minimum of 100,000. If you do not have all that money right now, you could start by accumulating capital through a money market fund. As we said earlier, you match an investment to your goal. You have a short-term goal of accumulating capital, so you use a short-term investment like a money market fund. When your savings hit 50,000 or 100,000, you can invest in a bond or a bill. You can invest in treasury bonds and bills in several ways. An easy way to go is through your bank. Several banks provide investment services, which is a quick and easy way to start. You could also go to a securities broker. You must pay a commission to the bank or to the security broker. Alternatively, you can go directly to the central bank and you would need to open a CDS account. This option allows you to bid whenever the government issues a new bond. If you have little or no experience with investing, go through the bank or securities broker. Treasury bills and bonds are an important part of your investment portfolio. They can help you reduce the total risk that you are taking. But even though they have been paying high returns in the past, you should not put all your money into them. If you did that, you would turn a safe investment into an unsafe one.